This is presented by HBS Connect, Japanese freight forwarder in Japan.
Hello everyone, this is Iino. Today I'm bringing you the logistics news for January 2026. We'll break it down into 6 key stories, covering renewed tensions in the Red Sea, developments surrounding the Suez Canal, and the outlook for ocean shipping and air cargo markets as we head further into 2026. Let's get started. Red Sea crisis reignites, Houthis signal possible resumption of attacks. Here is our first story. The situation in the Red Sea, which once appeared to be stabilizing, has once again entered a phase of rising tension. The Iran-backed Houthi group in Yemen has strongly suggested that it may resume attacks on commercial vessels sailing through the Red Sea. Behind this move is increasing military and diplomatic pressure by the United States on Iran. The Houthis released provocative footage on a video platform, accompanied by the word soon, implying potential attacks on merchant ships. In an official statement, they also declared that if the United States were to attack Iran, they would retaliate in the Red Sea. The Red Sea sits at the gateway to the Suez Canal, a critical artery linking Asia and Europe and carrying a significant share of global container traffic. Instability in this region directly affects shipping lines' decisions, influencing insurance premiums, crew safety, and overall operating costs. Earlier this year, there had been some optimism that carriers might gradually return to the Suez route. However, in light of these latest developments, that optimism has quickly faded. For shipping lines, avoiding foreseeable risks remains a higher priority than shortening transit times or reducing fuel costs. Sokhna port's new terminal and the reality of a Suez return. Our next story also concerns the Suez Canal. A new large-scale container terminal has begun operations at Sokhna port in Egypt. Located on the southern side of the Suez Canal, at the entrance to the Red Sea, Sokhna holds immense geopolitical and logistical importance. The new terminal is designed to accommodate large container vessels and includes plans for future capacity expansion. What stands out is that this project is not just a port facility, but part of a broader logistics network directly connected to inland industrial zones by rail and highway. Supported by such infrastructure development, the number of container ships transiting the Suez Canal has, in some weeks, reached relatively higher levels compared with the period immediately after the Red Sea crisis began. Some carriers are cautiously evaluating whether certain routes could once again use the Suez Passage. However, this does not mean a full-scale operational return. With Red Sea tensions flaring up again, including the uncertainty surrounding the Houthis, Suez is being considered merely as a contingency option on paper. These developments do not indicate that the Suez Canal has returned to being a safe, normal route. Shipping lines continue to regard the Red Sea as a high-risk area and are simply reassessing their options. SCFI falls for 3 consecutive weeks, slipping below 1,500 points. Our third topic is the current container freight market. The Shanghai Containerized Freight Index, or SCFI, has declined for 3 straight weeks, falling below the 1,500-point mark. This is the first time in about a month and a half that it has dropped to this level, signaling a clear downward turn in market conditions. A key feature of this decline is that major trade lanes, including North America, Europe, and the Middle East, have all softened, even those that had previously shown resilience. The main driver is the early end to pre-Lunar New Year demand. In a typical year, last-minute shipping demand continues into late January, but this year it slowed sharply by mid-January. Carriers attempted to adjust supply through blank sailings and capacity reductions, but they were unable to keep pace with the rapid drop in demand. The SCFI is one of the most sensitive indicators of short-term supply and demand. 3 consecutive weeks of decline suggest that real cargo demand is clearly cooling. In the short term, absent a strong catalyst after the Lunar New Year, the base scenario appears to be a weak to flat market. Will shipping lines fall into a $10 billion loss in 2026? Next, we turn to the medium to long-term outlook. Several research institutions have warned that container shipping lines as a whole could swing into substantial losses in 2026. The primary cause is the imbalance between supply and demand. fleet capacity growth continues to outpace cargo demand. Recent years of strong profitability were supported by exceptional factors such as front-loaded demand and longer sailing distances caused by rerouting around the Cape of Good Hope due to Red Sea tensions. These detours effectively absorbed excess vessel capacity that would otherwise have weighed on the market. If those supporting factors fade, surplus capacity will quickly surface. In particular, if demand weakens on the highly profitable North America trade, the industry's earnings structure could deteriorate significantly. For many carriers, 2026 may become a year of adjustment. Air cargo market tightness driven by AI demand and cross-border e-commerce. Our fifth story focuses on air cargo. In 2026, tight air cargo capacity, especially out of Asia, is expected to persist. The largest driver is AI-related demand. Semiconductors and server equipment for data centers are high-value, time-sensitive goods, making air transport the preferred mode. When combined with cross-border e-commerce shipments, load factors on certain routes and during specific periods remain consistently high. Taiwan and Vietnam in particular are strengthening their roles as supply hubs for AI-related products, pushing up air freight demand. In air logistics, success depends not only on securing space, but also on maintaining quality, such as temperature control, shock monitoring, and security compliance. At the same time, a recovery in passenger flights and the introduction of new aircraft are expected to increase supply over the medium term, creating a complex market where short-term tightness and longer-term adjustments coexist. U.S.-Venezuela tensions and their impact on shipping markets. Our final story. Rising military tensions between the United States and Venezuela are casting a shadow over maritime markets. In the short term, the direct impact on container and dry bulk markets is expected to be limited. There is little indication that cargo flows will change dramatically in the immediate future. However, over the medium to long term, structural shifts may occur, particularly in the tanker market. If sanctions intensify or supply constraints tighten, transport distances could lengthen, increasing ton-mile demand. Such changes gradually influence supply-demand balances and freight rate formation. Geopolitical risks do more than create headline news. They can alter the very assumptions underlying the market. These developments may become an important factor when considering future energy logistics and routing decisions. What did you think of this month's logistics news? From geopolitical risks in the Red Sea to shifting market conditions and structural supply-demand changes, looking ahead to 2026, the logistics environment is moving rapidly. Beyond short-term freight rate fluctuations, it is increasingly important to understand the medium to long-term structural transformations shaping the industry. That's all for today. Thank you very much.
In this channel, I explain about international logistics knowledge for your better understanding. I hope this video will be a good support for your logistics job. If you have any shipment from Thailand or to Thailand, please feel free to contact me, Iino-san, anytime. Also, I'm very motivated to keep updating these videos. If you subscribe, press good, or comment anything. Well, thank you. See you next time.